What's up, guys? How you doing? Maroon 5, you need to pipe her down. Alright. Whoa. Shh, quiet. Alright, so today we are talking a little bit about investment calculations. So these are geared towards those first-time investors that are looking to get into things. These are 3 good equations to know, memorize, put it in the noggin, and nail it down. So they are cap rate, 70% rule, and debt service. So I will go through these, I will explain them, and we'll do an example of each. If you have any questions or anything, hit me up, Facebook, you know what I'm saying? So here we go, let's get into it, and let's rock. So number 1 is cap rate. Alright, number 1 we are going to go through is, like I said, cap rate. Investors, you're always hearing them, what's the cap rate? Alright, so we're going to go through it, I'm going to explain it, and then you're going to lock it upstairs, and you're going to be a genius. Okay, so what is cap rate? Basically, cap rate is a calculation of the rate of return on an investment property, taking into account what you expect it to produce in income every year. So, how do you calculate it? This is what you do. You take the NOI, which is the net operating income, I will explain that, divided by the market value or the purchase price of the property. So, what the heck's NOI, and how do you calculate it? NOI, you take every month's rent, multiply that by 12, that will give you the gross annual income, okay? From there, you take the gross annual income and you subtract all expenses. So expenses such as property taxes or insurance, or if you're having a property management company manage the property, you subtract that. Subtract utilities. Once you take the gross annual income, subtract all expenses, that gives you, ding, 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 NOI. So then to calculate cap rate, you take the NOI and you divide it by the market value of the property. So let's do it. Let's do a little example and walk upstairs. All right. So let's say you've got an NOI of $30,000 a year. 30K. We'll divide that. We'll say the market value of the property is $175,000. 175K. Boom. Divide that out and you get 0.17, which is a 17 cap. And now, if you find that, call me because I want to buy that property because that's a stinking good cap rate. Now, that's hard to find. So, what I like to tell my clients is an 8 cap or above. 8 plus cap. Boom. I like that. 8 plus cap, you're looking fresh, looking good. I would say go after it if you like the property. Alright, so how do you calculate cap rate? You take the NOI, divide it by the market value. Alright, we're going to go on to number 2. If you have questions at the end, feel free to reach out, call, text, let's go. Alright, number 2 is the 70% rule, so let's get into it. Me do what I want when I come through. I need a girl like you, yeah, yeah. Yeah, yeah, yeah. Alright, we are on to number 2, the 70% rule. So this equation is super good for those that are looking to flip properties. This is a quick, easy way to come up with an offer price. So what is it and what is the equation? The equation goes like this. You take 0.7, which is 70%, alright? You multiply that by the ARV. I'll explain that in a second, and then you subtract rehab. So, some of you probably do not know what ARV is. ARV is the after renovation value. So that's after you take a fugly property and you flip it and make it super sexy. That's what the property will be worth when you sell it after it's looking fresh. Or what they like to say, perfecto. So that is ARV. And then you subtract the rehab. So this is the budget that you plan on spending to flip the property. Now, When you're using this equation, obviously you should definitely crunch your numbers like no other. Make sure you include soft costs as well. A lot of investors tend to forget this. And what are soft costs? Soft costs are the costs that you're gonna pay, like real estate commissions or closing costs. So at the end, once you finish the project, you've got, if you're using an agent, you'll have 6% typically in fees associated with using an agent, and then you'll have another 2% in closing costs to sell the property. So that right there is 8% right off your profit. So don't forget to include soft costs when crunching your numbers. So let's do an example. Let's take 0.7, multiply by, we'll say the ARV of the property, this is after it's flipped, looking fine, will be $200,000. Boom. Let's say we expect our rehab to be $60,000 to make it look fresh. 60K. So 0.7 times 200, it'll be 140. 140,000, subtract 60K. That's going to equal $80,000. This right here, my friends, should be the price that you offer. Now, this equation is very good, so long. Now, make sure that you're correct on your ARV and your rehab budget. If these are off, then this equation sucks because, well, all your math is wrong. So, it's a very simple, quick, easy way. If you're looking to flip properties, this is a good, easy equation to use. So, what is it? 70% rule. You take 0.7, multiply by the ARV, and you subtract your rehab, boom, you get your offer price. Try to stay as close to that price as possible. Oh, it's getting stinking hot in here. So we made it. Number 3, last but not least, my friends. All right, the third equation is debt service. So this equation is critical for getting financing. This is one of the number one numbers that banks look at when determining whether to finance your property or not. So, how do you calculate debt service? Let's go over it. Debt service, you take the NOI, now you remember that because I already taught you it. It is gross annual income minus expenses. Boom. NOI, you divide it by the amount of debt that you're going to be taking out on the property. So, let's do a little example. Boom, we will say we've got an NOI of $250,000. We're gonna make things a little bit bigger here, all right? We'll say we took out a debt of $200,000. Boom, divide that out, that will be 1.25. All right, so you're probably like, what the crap does that number mean? Well, what banks look at, if you've got a number right here that is less than 1, less than 1.0, that's a 0. That means you are in the RED, red. We don't like the stinking red. We like the green because green's like money and green means positive. So that's bad. That means you are losing money every month, which that sucks and we do not want that. And a bank is not going to want to finance that. So if it's less than 1, that's bad and you're not going to get financing. Banks typically look for numbers to be greater than 1.2. So as you can see right here, we are just above 1.2. So that is a positive. Good for you. You did it. And that's a good one. All right. So I hope this helps. This is debt service. You take NOI divided by the amount of debt that you're taking out. So we're going to do a little bit of recap. What did we go through? Boom, boom. And then I'll send you on your way to start making some money. Let's go. All right. We made it. So to recap, today we went over cap rate, we went over the 70% rule, and we went over the debt service equations. Little quick cap. How do you calculate it? You take the NOI and you divide it by the market value. Ding, 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 ding. The second one, 70% rule. You take 0.7, which is 70%. You multiply that by the ARV after renovation, a value. And then you subtract the rehab budget, and that gives you what you should offer for the property. A bang bang. Okay, lastly is debt service. You take the NOI and you divide it by the amount of debt that you are taking out on the property. If it is less than 1, that is a wah wah. That's not good. You want it above 1.2. Banks like it. I like it. Yeah. So I hope this was helpful. If you or friends or family are looking to invest in Tampa, St. Pete, Clearwater, I'm your girl. I'd love to help you out, make some money. You make money, we all make money. It's a fun time. All right, I hope this was helpful, and I will see you guys later. Yeah, yeah, yeah. Yeah, yeah, yeah.